Depression of 1920 to 1921. When the First World War ended, the United States found itself with a wartime economy that had no war to feed. Government spending collapsed. The Federal Reserve, alarmed by post-war inflation, raised interest rates sharply. Between 1920 and 1921, the U.S. economy contracted by nearly 24%, and unemployment reached 11.7%. It was, by most measures, one of the sharpest economic contractions in American history. It is also one of the least remembered, because it ended quickly. The government cut spending further instead of expanding it. The Federal Reserve eventually reversed course, and the economy recovered within 18 months. Economists still debate whether the speed of the recovery was because of the hands-off response, or in spite of it. The episode is frequently cited by those who argue that recessions can self-correct without intervention, and just as frequently disputed. Great Depression. The Great Depression began with the U.S. stock market crash of October 1929 and became the longest and deepest economic collapse the modern world had seen. Between 1929 and 1933, U.S. GDP fell by 30%, unemployment reached 25%, and roughly half of all American banks failed. The causes were multiple and reinforcing. The stock market crash destroyed wealth and confidence. Bank failures wiped out savings and contracted credit. The Federal Reserve, fearing inflation, raised interest rates in 1931 in the middle of a depression. The Smoot-Hawley Tariff Act triggered retaliatory tariffs that collapsed global trade, and the gold standard prevented governments from expanding their money supplies in response. What made the Depression great, as distinct from the many panics and recessions before it, was the combination of all these forces acting simultaneously, and the policy failures at every stage. It did not end until the Second World War forced the level of government spending that had been argued against for a decade. Recession of 1937. Within the Great Depression sits a smaller, largely forgotten crisis. By 1937, the U.S. economy had partially recovered under Roosevelt's New Deal spending programs. Believing the recovery was secure, the Roosevelt administration cut government spending, and the Federal Reserve raised reserve requirements for banks, both moves intended to prevent inflation. The economy immediately contracted again. Unemployment, which had fallen from 25% to 14%, jumped back to 19% within a year. The recession of 1937 is a precise natural experiment in the consequences of withdrawing fiscal and monetary support too early. It remains the central case study for economists who argue that austerity during a recovery is indistinguishable from austerity during a crisis. Oil shock of 1973. In October 1973, Arab members of OPEC imposed an oil embargo on countries that had supported Israel in the Yom Kippur War, including the United States. The price of oil quadrupled within months. Every sector of every developed economy ran on oil: manufacturing, transport, heating, agriculture. When the input cost of everything rises simultaneously, prices rise across the board, regardless of demand. The result was stagflation, inflation and unemployment rising together, which the standard economic models of the time said was impossible. The Phillips curve, the theoretical trade-off between inflation and unemployment, broke down visibly and publicly. The 1973 shock forced a fundamental revision of how economies were understood to work, and gave momentum to monetarist economists, led by Milton Friedman, who argued that controlling the money supply was the primary lever of economic management. Volcker Shock. By 1979, U.S. inflation had been running above 10% for years, a legacy of the oil shocks and of successive governments unwilling to accept the unemployment that would come from fighting it. Paul Volcker, appointed Federal Reserve Chairman by Jimmy Carter, decided to end it. He raised the federal funds rate to 20%, the highest in American history. Credit became extraordinarily expensive. Borrowing collapsed. Business investment fell. The U.S. entered two recessions in quick succession, in 1980 and again in 1981 to 82. Unemployment reached 10.8%. Volcker held the rate. By 1983, inflation had fallen from 14% to 3%. The Volcker Shock established the modern consensus that central bank independence and credible inflation targeting were the foundations of a stable economy. It also destroyed the savings and loan industry, triggered the Latin American debt crisis, and remains one of the most deliberately inflicted economic contractions in history. Latin American debt crisis. Through the 1970s, Latin American governments borrowed heavily from international banks, largely to finance development spending. The loans were denominated in U.S. dollars at floating interest rates. When Volcker raised U.S. interest rates to 20%, the cost of servicing that debt multiplied. In August 1982, Mexico announced it could not make its debt payments. Brazil, Argentina, Chile, and most of the rest of the continent followed. At its peak, 13 Latin American countries had restructured their debts. The crisis consumed most of the 1980s. GDP per capita fell across the region. In many countries, the decade is simply called La Década Perdida, the lost decade. The IMF intervened with conditional loans that required spending cuts, privatization, and liberalization. Austerity programs whose effects on ordinary populations are still contested. The crisis demonstrated the specific danger of borrowing in a foreign currency. The exchange rate risk is invisible when times are good and catastrophic when they are not. Black Monday. On October 19, 1987, stock markets around the world collapsed in a single day. The Dow Jones Industrial Average fell 22.6%, the largest single-day percentage drop in its history, before or since. The crash was global. Hong Kong fell 45%, Australia 41%, the United Kingdom 26%. There was no single clear cause. Computerized program trading, automatic sell orders triggered by price drops, amplified the decline mechanically. Valuations had stretched. Trade deficit figures released that week had unnerved investors. Whatever the initial trigger, the speed and scale of the collapse shocked markets that had assumed volatility of that magnitude was impossible in modern, liquid markets. The real economy barely flinched. Recessions did not follow in most countries. The Federal Reserve flooded the system with liquidity, and markets recovered within 2 years. Black Monday is remembered primarily as a lesson about the gap between financial market volatility and economic fundamentals, and about the dangers of automated trading systems acting faster than human judgment. Japanese asset bubble. Through the 1980s, Japanese asset prices entered a spiral that became one of the most extreme in modern history. The Nikkei stock index rose 300% between 1985 and 1989. Tokyo real estate became so expensive that the grounds of the Imperial Palace were theoretically valued higher than all the real estate in California. The bubble was inflated by loose monetary policy, financial deregulation, and the specific dynamics of Japanese corporate culture in which banks, companies, and government were deeply intertwined. When the Bank of Japan raised interest rates in 1989 to cool the market, the bubble burst. The Nikkei lost 60% of its value by 1992. Property prices fell for 15 consecutive years. Banks that had lent against inflated collateral became technically insolvent, but were kept alive by government support, rather than wound down, creating zombie banks that neither failed nor functioned. Japan's economy stagnated for more than a decade. The Nikkei did not return to its 1989 peak until 2024, 35 years later. Asian financial crisis. In July 1997, Thailand abandoned its currency peg to the US dollar. The baht collapsed. Within months, the crisis had spread to Indonesia, South Korea, Malaysia, and the Philippines. Economies with different structures, different governments, and different problems, connected primarily by being in the same investor category. The common vulnerability was external. All had borrowed heavily in US dollars during the boom years, and all faced the same problem when their currencies fell. The cost of repayment in local terms multiplied overnight. Indonesia was worst affected. The rupiah lost 80% of its value. GDP contracted by 13%. President Suharto, in power for 30 years, resigned. The IMF intervened with the largest rescue packages in its history to that point. attached to conditions requiring spending cuts and bank closures that deepen the recessions in the short term. The Asian financial crisis broke the assumption that rapid growth in developing economies represented a permanent shift in trajectory, rather than a cycle that could reverse. Dot-com crash. Between 1995 and 2000, the Nasdaq index rose 400%. Investors poured money into internet companies on the theory that the internet would transform every industry and that market share mattered more than profit. Companies with no revenue, no clear business model, and sometimes no product raised hundreds of millions of dollars. The logic was circular. Investors bought because prices were rising, and prices rose because investors were buying. The bubble peaked in March 2000. When it turned fast. By 2002, the Nasdaq had fallen 78% from its peak. Roughly $5 trillion in market value was destroyed. Many companies that had been worth billions simply ceased to exist. The crash did not cause a depression. The real economy contracted but recovered within 2 years. But it wiped out a generation of retail investors who had been told that technology stocks were different from all previous speculative manias and that the old rules no longer applied. Global financial crisis. The global financial crisis of 2007 to 2008 was the most serious financial crisis since the Great Depression. Its origin was the U.S. housing market. Through the early 2000s, mortgage lenders issued loans to borrowers who could not service them under any realistic scenario, subprime mortgages, on the assumption that rising house prices would always provide an exit. These loans were bundled into securities, mortgage-backed bonds, collateralized debt obligations, that were sold to banks, pension funds, and investment vehicles around the world. Rating agencies assessed many of them as safe. When U.S. house prices began to fall in 2006, the assumptions behind these securities broke down simultaneously. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September 2008, the largest bankruptcy in American history. Credit markets froze globally. Governments intervened with bank bailouts, emergency lending facilities, and fiscal stimulus on a scale not seen since the Second World War. In the UK, Ireland, Iceland, and Spain, entire banking systems required state rescue. The recession that followed cost millions of jobs across every developed economy, and the political consequences, a decade of austerity, rising inequality, and collapsing trust in financial institutions, lasted far longer than the crisis itself. European sovereign debt crisis. The global financial crisis exposed a structural problem in the Eurozone that had been building since the Euro's creation. Countries sharing a currency cannot devalue individually to regain competitiveness. They are locked into the same exchange rate regardless of their economic conditions. Through the 2000s, Southern European economies ran large deficits and accumulated large debts, financed cheaply, because markets assumed Eurozone membership eliminated the risk of default. When the crisis hit and growth collapsed, those debts became unsustainable. Greece was first. In 2010, it revealed that its deficit was far larger than previously reported. Bond markets immediately demanded much higher interest rates to lend to Greece, then to Ireland, Portugal, Spain, and Italy. The European Central Bank, constrained by its mandate and by political disagreement among member states, was slow to respond. Greece required 3 separate bailout programs between 2010 and 2018 and underwent the largest sovereign debt restructuring in history. Austerity measures required as conditions of the bailouts cut public spending, wages, and pensions across the affected countries. Youth unemployment in Greece and Spain exceeded 50%. The crisis did not end until ECB President Mario Draghi announced in 2012 that the bank would do whatever it takes to preserve the euro, a commitment that stabilized bond markets almost immediately before a single euro had been spent. COVID-19. In March 2020, governments across the world shut down their economies to slow the spread of a pandemic. The resulting contraction was the fastest in recorded history. Global GDP fell 3.5% in 2020, larger than the 2008 financial crisis, but compressed into weeks rather than years. Unemployment in the United States reached 14.7% in April 2020, the highest since the Great Depression, and then fell back below 6% by October of the same year. The policy response was also unprecedented in speed and scale. Governments introduced furlough schemes, direct cash transfers, and business loan programs within weeks. Central banks cut interest rates to zero and launched asset purchase programs. The crisis was unusual in its mechanism. It was not caused by a financial imbalance or a policy error, but by a deliberate, necessary suppression of economic activity. The recovery was faster than almost any model predicted. The consequence was a different kind of problem. Supply chains disrupted by shutdowns, combined with demand unleashed by stimulus payments, produced the highest inflation in 40 years across most developed economies by 2021 and 2022. The cost of the fastest rescue becoming the next crisis to manage. Thanks for watching. If you found this useful, be sure to like and subscribe. Also, be sure to watch part 1 if you haven't.